We will talk about current state of IKEA. IKEA market share is 5% in 2020. The table shows the IKEA and its competitors, which are Wayfair, Home Depot, Williams Sonoma, and Target Group, and also show the revenue market share and the other data expected to show annual growth rate of 4.7% during 2020 to 2024. For now, why IKEA didn't decide to go for IPO? If a company issue share, the shareholder will claim for quicker and more benefits, which will put much pressure to the managers, forcing them to change the long-term objective to short-term pursuit, which may lead IKEA change their strategy and not being able to stick on their original plan and losing scalability and creativity.
In the 2019, IKEA's total revenue is about $36.7 billion US, of which the share created by online is about 11%. IKEA return on asset is 18%. However, if IKEA changes their mind and decide to go for the IPO, they can benefit from following advantages, such as utilizing the separation of equity and management. IKEA will operate smoothly despite the frequent change of owner under the advantages of separation. Also, the salaries paid to the employees take a big part in their cash flow. Once they go for the IPO, they can issue shares to the employee and try to transfer employee salary structure. In this way, they can lower down the impact that salaries causing to their cash flow and get more liquidity for investment or financial project.
In this slide, we have created a DCF model in order to find out the pre-IPO enterprise value of IKEA. In order to make the projections, we have used the historical data of IKEA and also the compatible competitors like Walmart, Amazon, and Target. In the right-hand side of the table, we calculated the WACC in order to find the terminal value. After we found the enterprise value and subtracted the net debt from it, we found the equity value of $9.6 billion. Thus, we got the pre-IPO value per share, which is equal to $17.
For the IPO process, first of all, the ideal capital structure is based on the trade-off theory, where it's a trade-off between lowering the cost of financial distress versus raising more debt. In today's world, where economic growth is persistently weak, coupled with companies have narrowed their investment space, reduced their yields, and shifted their objectives from profit maximization to debt minimization, accelerating deleveraging and intensifying credit contraction. Under the above content, the trade-off for IKEA will be raising more equity to keep the risk of financial distress in a controllable level. With suggested capital structure, equity to be raised comes to $13.5 billion. Then with different discount rate of share price, IKEA's share price would exceed the average prices growth on NYSE furniture industry by 30% after the IPO. Therefore, IKEA will publish 1.05 billion share with an offering price of $13.39 per share. As IPO figure shows the underpricing problem, for this case, the problem may come from, firstly, most investors don't have the information for the IPO. Secondly, the potential investors are unable to get the shares during the process. Thirdly, due to homogeneous company overlap with IKEA's product line and the impact of e-commerce giants on traditional furniture retail, along with nowadays global supply chain pressure, investor risk aversion to consumer goods market rises. The level of underpricing depends on the stable future growth, IKEA's brand premium among all furniture product, and liquidity in upstream property market.
The CAPM model assumes the relationship between risk and return is linear, so the higher the asset rate is, the larger the asset return is required. Our risk-free rate is the 10-year treasury rate, which is 0.93%, a market risk premium of 70.4%. The beta of IKEA is 1.03, which implies that IKEA will change 1.03 while the market risk premium changes by 1. Therefore, our expected return of equity is 80.86% with the underlying assumption that the market is efficient. Moving on to the APT model, it has a multi-factors asset pricing approach. Our APT model suggests that if assets are temporarily mispriced, arbitrage opportunity will drive the price back up to a fair value. In this case, the independents we can use include inflation rate, GDP growth rate, and the other macroeconomic factors. Our target capital structure will be 1/3 of debt and 2/3 of equity. It considers the fundamentals of a world economy during unprecedented change, weighing up multinational consumer goods giants' risk resilience of their earning systems and the benefit of interest tax shield. We suggest that IKEA to raise 14 billion equity in response to its global expansion and to counteract the bearish impact on the bond markets from rising market interest rates caused by the US taper. The suggested price is $30.4 per share of the price range between 30.4 and 15.1, which has underpricing problem due to the real market is not perfect. We've proposed 1.05 billion of shares to be sold, where 65% of IKEA's equity shares will be held by public investors after IPO. Last, CAPM model suggests that the expected rate of return on equity would be 80.86%, and according to the APT model, returns may less than expected, and the situation needs to be examined in the context of multiple factors in different markets.